You are listening to Keystone's Stock Talk Show, episode 275.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
Back from our research trip to LA's LD Microcap Conference, it's great to chat with you again as we prepare for our last live webinar of 2024. Get your tickets today. And of course, we are preparing for the epic conclusion to the sideshow production the US election has become. I start with our Your Stock Our Take show here, answering a viewer question on Converge Technology Solutions, CTS on the TSX, an IT service provider offering hardware, software, managed services, and professional service to its mid-market clientele. Converge is well followed by the big banks and brokerage in Canada because it does a good deal of investment banking. But its stock is one that we have continued to advise avoiding. After pre-releasing lower Q3 guidance recently, the stock was down 32% in the last month. We will let you know if the drop alters our opinion on the stock. Brett takes a look at Super Microcomputer, symbol SMCI on the NASDAQ, a provider of application-optimized high-performance servers and storage solutions. While only down 6% year to date, the company is off 78% from its peak this year in a very volatile 2024 for the company year to date. Brett lets you know why and if we continue to recommend avoiding the stock. Finally, Brennan answers a viewer question on Toromont Industries TIH is the symbol on the TSX, which provides specialized capital equipment in Canada, the United States, and internationally. The company is a dividend aristocrat, having grown its dividend consistently for the past 35 years. We will let you know if this high-quality business offers growth at a reasonable price today. All right, let's get to the show. My co-host, Mr. Aaron Dunn, is down for the count. He's under the weather today. I will have the killer bees, Brett and Brennan, with me. How are you guys doing?
Doing well.
Yeah.
I was
back from LA.
Yeah, you guys are back from LA. I'm just basically back from Vegas. I was at a wedding. That's why I'm wearing my Vegas shirt. But yeah, how was LA, really guys? How was the conference?
And the viewers, thank you so much.
I'm sure Ryan's thinking like, why did you wear that? Get a professional shirt on.
Great, Brennan. No, it's good. How was our? We had a number of productive meetings. A couple companies that we know well in coverage. Some new companies. One very interesting. I won't talk about today. That we have to do some follow up on. But for our U.S. coverage, but it does look quite interesting. But a couple companies, sat down with Geodrills management. We know the company quite well, and the outlook continues to be long term positive. So it's good to see.
That's good.
And we have some upcoming webinars that I wanted to chat about briefly today. There's 3 of them, but really the 2 that you need to know about are coming up on the 7th of November. So that's this week, and the 12th of November next week. 7th is 7 p.m. Pacific. The 12th is 7 p.m. Eastern. Now, these are called the New Stock Portfolio Dividend Growth Stars as rates fall in the next 10x stocks. So we're always asked who should attend. We say investors looking for unique, profitable stock recommendations, both dividend growth stocks and small cap companies, and advice on building a better 15 to 25 stock portfolio. You'll get 9 traits to help you uncover the next 10x stock, a simple formula that's allowed us to uncover not only 10x stocks, but even 200x stocks like the Hammond Powers of the world, which are up over 20,000%. And, if you want proof, this time last year, the first companies that we recommended around that webinar, one after, one slightly before, the one right before was Cipher Pharmaceuticals, traded then at around $3.89. Today, it's around $16. That's up over 300%. VitalHub, the first company we recommended after, we'll probably talk about it as a star next week. The stock was then at $3.24. It's gone over $10. That's up 220%. So just good quality, cash rich at the time, cash flowing businesses trading at low valuations. And I'll compare slightly today. I'll compare VitalHub to one of the businesses that I'm talking about in the Your Stock Our Take. So don't miss those out today. We'll give you that 4 top dividend stocks just for attending. So get those. There is one, if you've been convinced, if you've been listening to our podcast for years now and you want us to help you build that simple 15 to 25 stock portfolio, we'll give you 15 stocks in a full webinar with an annual VIP membership as well. And that is on November 16th. You can get those details at www.keystocks.com. Now let's get to the poll question. Unless you want to say something about the webinar, Brennan, because you look really so much like you want.
I'm looking forward to it.
I mean,
thanks for hearing that. Yeah.
The times change. So, I'm always stuck in Saskatchewan. So, it is 7 p.m. Pacific. But technically it's 9. Well, I'm Central. I'm Central. So technically it's 9 till midnight for me. So
you live guys in another universe.
Seeing me right up until midnight. So, I'll make sure that I stay awake. But yeah, no, I'm looking forward to it, and it should be good. I always look forward to, the Q&A session as well.
Yeah, again, we offer that right at the end, about 30 minutes. Ask any and all questions on North American stocks and anything we talk about in the live webinars. It's our last of the year, so get those tickets. They typically sell out. We go to our room limit, and then we just don't allow any more tickets. The poll question. It's Goldman Sachs came out with released their S&P 500 10-year outlook. Kind of made headlines, right?
Yeah. So like what I was saying, this is annualized return, so 3% average on year over year. And they are expecting 3% as their baseline expectations for the next 10 years. So in their 2 standard deviations from negative 1% to 7%, which a lot of other Wall Street firms are expecting more 7%. So there's a bit more, it was lower and it made some more headlines. And the question is, do you expect S&P 500 to perform better or worse than Goldman's 3% expectation? 67% said yes, the S&P 500 will return higher than that over the next decade. 22% said it will return roughly 3% over the next decade. And the 11%, which are more bearish than even Goldman, believe that it will perform worse than 3% over the next decade. And the Goldman report, I'll link it in our description as well. I linked it in the poll. It's actually quite interesting because it really shines light on similar topics that we've been talking about recently too, with certain stocks really being concentrated. So the Magnificent Seven being the concentrated group in the S&P 500, as well as having very high valuations, which have propped up the entire index's valuations. And they're really forecasting the summarization of it is they're expecting a multiple contraction. And over the last decade, we've seen that expansion. And when you have a multiple contraction, even if earnings are going up, it ends up being a lower return over the period.
Yeah, and I mean I believe they're citing like a cyclically adjusted PE ratio in there. I mean, it's an interesting read for sure, and they're looking at the effective or implied future annual returns going forward. But if you just look at this cyclically adjusted PE, which is one thing we look at to gauge the overall valuations on the market, in the past 20 years, it's only been higher once, and that was kind of in the crazy period post-COVID in 2021. And if you go back to that all time, it's really only been higher once, I believe, and that was in the .com craziness. So yeah, you're talking about high valuations of the market. Now, there is some bifurcation of the market. We've been talking about that for a couple of years now, where the Magnificent Seven are really powering the market returns. So if you're looking at the other 100 or 493 companies, you might be able to find some individual value in there. And, they may be calling for a compression of multiples on those 7 Magnificent Seven that are almost, I think they're 35% of the market right now, right? It's a crazy amount that is just those 7 companies. So, I mean, Are we buying an index ETF right now? No. Can we still find some value in the S&P 500 or US stocks? We don't even always have to just look at the S&P 500. We can look at there's 10,000 other stocks in the US market we could look to as well. So I think it is what one would consider a stock picker's market right now, and you're always that's what we are. So I know we have to dig in, look at all companies and come up with good value wherever we can find it.
Well, and even like I heard, or go on, Brett, if you want to make.
I was even going to mention, like, out of even the Magnificent Seven, like a company which I haven't heard talked about much is Eli Lilly, and even their multiple has expanded significant.
Yeah,
and that's to do more with like the Ozempic, the G1 drugs, but it's still, you're seeing like, or Costco, another company where it's not in that tech space, but it's still seeing a really uplifted multiple. I think they're around 40 times or something like that, where historically they were closer to 20. So you've really seen people flood into certain, even
big names, well-known, high-quality names are really getting, like, I love Costco. It's a great business, but the multiple being paid on it right now is high. And great company. Would I be rushing in to buy a full position right now? No, but I mean, you could have said that for the past almost 18 months on the stock, right? And it had continued to move higher. Will it? It's probably due for a correction. It's probably like those companies are probably due for a correction, is what I would say. So, but that doesn't say we can't still find value. I mean, we're looking at companies that are trading at 10 times multiple with 15 to 35% growth. So, and good balance sheets. So it's kind of down market a little from the high end of the market where you really are seeing higher end valuations.
Yeah. And like, one thing that we've heard, I mean, and Ryan was saying that he just recently heard this in LA as well. And I was at another conference, another small cap conference, and we heard around, just people saying, wow, it's been horrible out there for small caps and micro caps. And we're just thinking, has it been? I mean, a lot of our picks have been doing very, very well recently. So it's just interesting, again, like Ryan was kind of saying, like it's kind of like a stock picker's market, at least at this point. I mean, as long as you're picking the right stocks. And again, I believe, in my opinion, there's still kind of like that risk off trade, especially after we've just saw, everybody putting these lofty EBITDA multiples on their stocks, around, right after that COVID period. Well, now that's gone. People kind of are still scared of, the outcome, or basically the wrath of when all of a sudden the market isn't looking for those and they're actually looking for real earnings. And again, it's the stocks that we've seen great returns that we're recommending, are again these profitable businesses. And again, it's just kind of interesting that we went to multiple of these, small cap conferences where we're hearing the same thing of the market's been horrible out there, but again, we're kind of seeing the opposite, or I would say.
Yeah, I know. I mean, last 18 months, I'm hearing that at those events, and it's, if you were in speculative companies that were driven by a story and not by earnings, it's probably been a horrible 18 to 24 months. If you've been in cash rich, cash producing, growing businesses, it should not have been a bad. In fact, it should be. I mean, I could just list off like companies like Aritzia, like companies that have doubled from our coverage plus in the past 18 months, Cypher, Dynacor, Firan,
don't give them all away.
Yeah. Okay. I mean, there's a ton of, but I mean, those aren't buy recommendations right now for everybody who's listening, but I mean, I could have went down. There's about 8 companies, like, and we're not talking about a long list here that I can go through over those businesses. But again, they all fit that profile that I was talking about. So we heard that at that event as well. And it shocks me because it is not what we're seeing from like high quality businesses, even companies we've just introduced to coverage this year that match that criteria that have already jumped. You're certainly getting rewarded for good quality businesses. You're getting punished. I mean, we're going to talk about a company today that, just can't make accounting earnings, and the cash flow per share is, I mean, EV to EBITDA looks low, but when you have net debt, when it's not a great way to value these companies. So look at it on a free cash flow basis, because you can't look at it on an earnings basis. those businesses aren't getting rewarded, and they shouldn't. The markets are reacting more rationally now than they had, say, 3 years ago.
Yeah, it's really been like a flight to quality, and that's why you've seen
even in the small cap,
even in the small cap side. But there's just a lot more just poor performing companies, poorly structured companies, less quality companies in the small cap space. Then, because at a certain point, a big company, it has to be successful to a degree. And indexes like the S&P 500, they self-select that because they do require net income. They do or trailing net income of over 4 quarters. So they have to have revenue, of course, on top of that. They'll most likely have at least somewhat a decent of a balance sheet. Things like that were self-selecting, but that doesn't mean everything's even fair value within those indexes. And that's probably why you've seen all these ETFs that are based off of passive indexing do so well this year, because they at least hit some of those check boxes. But if they can't support those multiples in the next 10 years, like Goldman Sachs are saying, then you do have that contraction at that point, and that's where those ETF, those passive plays start to fall apart.
All right, should we move into the show?
Yeah.
Or do you have something, Brandon?
I was just going to say that we've picked the mug winner. We've mugged,
yes.
Before we get into our first year stock, our take.
Here it is. Thank you.
So yes, we picked. It goes to Anne. And it was from her submission of ADF Group. I believe Brett ended up doing that on the podcast as a Your Stock Our Take. So, good company,
interesting quality company for sure. Yeah.
So we are sending it her way. I've already been in contact with her.
It should be sent out. Yeah,
shortly. Good. Anyways, now let's...
Okay, I'm going to be looking at Converge Technologies. They are based out of Toronto. They are an IT service provider offering hardware, software, managed services, professional services to mid-market clients. The company works with leading technology vendors, has technical expertise in hybrid IT, multi-cloud architecture, cybersecurity, analytics, and DevOps. Trades around $3. Market cap around $605 million, does have a 1.95% dividend yield. So what has the company done year to date? We can see its stock price there. So down around 25% on the year. It's also down about 75% from its 2021 highs. Now, the stock has also dropped just around 32%, almost 33% in the past month. The drop is largely a result of the company's October 24th announcement that it was lowering Q3 guidance, as we can see right there. Let's take a look at the actual release and the key points from this. They pre-released the following. Gross profit was going to be approximately $158 million, down about 9.1% from Q3 2023. Versus the prior guide of between 172 to 178 million. It's a 10% reduction at the midpoint there. And adjusted EBITDA would be 32 million. That's down 22% from Q3 2023 and about 29% reduction at the midpoint of what they were guiding at for the quarter in itself. The reduced results were attributed to a few factors. Certain billing, which were expected to land in Q3, have been pushed to Q4 and into fiscal year 2025. Additionally, there was lower than expected demand in North America related to data center, networking, and storage solutions due to budget constraints, as well as IBM's mainframe product cycle and a challenging year-over-year compare versus last year. In addition, the endpoint user device refresh cycle has been pushed out again, with expectations that buying will ramp up by mid-2025, a good deal of negatives here, though, in the mid and near term. So let's look quickly at the numbers. These are from the previous quarter, Q2, as we see here, the 3-month period. The numbers were okay here. Although you can see revenues, again, were down, and net loss was significantly higher. Adjusted EBITDA was higher, but we'll talk a second about if that's a good way to value a company like this. We look at the balance sheet here. So net debt position, cash is 174 million, debt 425 million. So net debt is 251 million. Revenue, again, So we can move on here. We can just go to valuations for this company. Valuations here, adjusted EBITDA to EV was, or based on a forward basis into 2025, is about 5.7. Enterprise value to free cash flow is 19.4. And the PE, we can't calculate it on a trailing basis because there are no earnings here. Again, while the EV to EBITDA may look attractive, we do not expect much growth in EBITDA and view EBITDA in this case, and again, this is adjusted EBITDA, we view it as a less than optimal way to value mid-cap to small-cap companies with net debt and low margins. The free cash flow multiple shows a less than attractive valuation here. To give you, particularly given the growth expectations, to give you an idea of why we think this is not a good margin for the business, we can compare it to other, I mean, it's not even a comparable type business, but it is a small cap, a software business, Vital Hub. We were able to buy at this time last year at under 10 times free cash flow. Despite the significant drop in Converge's share price, it still trades at around 20 times. So Vital Hub we bought this time last year at half the multiple. Well, there was growth organically in the business where we don't see that in Converge. So Vital Hub over that period of time is up 220%, where Converge continues to drop. The PE, again, I said it's non-existent because there is no earnings. So let's just have our conclusion here. Converge faces weaker end market near term and midterm, and a drop in revenues is expected. Earnings, EBITDA, and cash flow, they're all expected to drop. Optimistically, we could see a slight recovery in fiscal year 2025, but the analysts told us that was going to happen again. We're going to have growth in 2024, and it doesn't look like we're going to be there this year. This is a company, again, with significant net debt, and expected adjusted EBITDA margin in the next quarter is expected to be 5.2. Then for the full year, 6.2, and next year, just 6.6. So those are relatively low, or they're very low, in our opinion, adjusted EBITDA margins. This is a business that continues to lose money, again, on an accounting basis. Converge just does not meet our basic criteria. Despite this, the company receives plenty of analyst coverage. It's a low margin, low organic growth, now debt-heavy business that really does not have a compelling investment case. But again, it receives all of that coverage because it does consistently what Bay Street and the big banks are looking for. That's raising capital, making acquisitions, transactions that make big banks and brokerages money. But the business is not making much money, and shareholders have unsurprisingly seen significant capital destruction over the past 3 years in the stock. Perhaps the business is sold one day, but this is not the structure of business that we would recommend and see as driving long-term value for our clients. Because Converge is well covered on Bay Street, we expect to continue to field many questions on the company, but as we've stated in the past, unless something fundamentally changes with the business, we expect to continue to advise investors to avoid Converge.
Yeah, and that's the thing. Like, they're just, we've said this last time we covered the stock, or I covered it. Their goal is to expand those adjusted EBITDA margins. But in 2020, it was adjusted EBITDA margin of 5%. I think in early 2022 they ended up getting a couple quarters at just shy of 7%. But now we're in, like Ryan's projections were showing for 2025.
Last quarter, yeah, and then
in the last quarter, we're again looking at this exact same range, and it's just, how can you get excited about a company
even if you're going 6 to 8? Like, we consider 10% low.
Exactly.
So
exactly.
I mean, and again, that, just to put that in perspective, we're considering 10% low, and this is an adjusted basis too. So there's the company just isn't significantly profitable. And when they came to the market, they did a ton of acquisitions. They grew not organically, but just by acquisition and from raised capital. And then they finally went into debt doing that because they kept making acquisitions, shelling out capital, and then issuing shares. And now you get into a position where they can't grow anymore because they're not able to make acquisitions. And now they're selling off and trying to pay down debt. And now there's a lack of growth. It's just, we just low margin business, no organic growth, basically is what we see right now. And It's not the type of business that we are looking to invest in. There are worse businesses out there than Converge, far worse, but it just doesn't meet our criteria. I think you're muted, Brett.
Yes, I was. When you are looking at these software companies, the thing which investors and anyone who's really looking at them love is the high margins, and that just doesn't exist here. So
they're a reseller, basically.
Yeah, exactly. And that's really the key difference I wanted to mention, which Ryan beat me to was that they are reselling it. You're not getting that full degree. You're not getting that 50, 60% gross margin on a company, a software piece, which many other software players will. And that's why you can't value them the same way, which I think quite a few people in the market were seeing them just as they develop their own software. They're not reselling it. They get that full margin, where that's just not the case.
All right. I think that beats that dead horse at this point. Let's get to our next company. Brett's got that. And Brett this week is looking at, you tell me.
Already forgot, didn't you? Super microcomputer.
Yes.
Again.
No, I actually, and we talked about that. It's great that you are looking at them. We'll talk further about them in a sec, but I was on a panel earlier this year, just in September. So not that long ago in Toronto, and the gentleman beside me, who was more a thematic investor, mentioned super microcomputer as his basically sole recommendation there. I kind of looked at him sideways because we had just looked at it, and it didn't meet our criteria in terms of where the valuations were. And we'll see what the company has done since then. Brett's going to go over it.
Yeah. So Super Microcomputer, symbol SMCI on the NASDAQ, is a provider of application-optimized high-performance server and storage solutions. The company develops and builds server and storage solutions at scale with its building block solutions. The company manufactures motherboards, server racks, and enclosures, but the CPU, GPU, storage, memory, amongst other of more of the compute components are bought and then integrated into a server. They assemble it. The stock has had a turbulent year, to say the least. The stock is trading at $26.77. A share down for about 6% year to date, which doesn't really sound turbulent at 6%. That could be trading on a day, and that would be turbulent for a day, not a year. However, the stock skyrocketed to over $120. At its peak was actually $1,200. They've done a 10-for-1 consolidation, but $120 adjusting for that. So it is now down 78% from that peak just in March of this year. The market cap is currently at roughly $14 billion. So a quick overview, really a timeline of the negative events on some of the biggest decreases in following various events since March. So April 19th, the stock fell 23% as the company did not provide preliminary results like it had done in the past, which generally just worries the market when you see a shift from a norm. That really spooks the market whenever you have anything like that. It can be not a big deal once things come, but it can spook, especially when you're looking at these forward-based numbers like SMCI is. Then moving forward to August 7th, the stock fell another 20% after poor preliminary results for its fiscal Q4, notably weak margins, with a gross margin of only 11% compared to prior quarters in the last couple of years being in that 15 to 19% range. So when you are seeing a 4% 4% drop in gross margin sequentially quarter over quarter, that is just a red flag, signs to worry. Then August 28th, Hindenburg Research, a short seller, released a short report on the company, causing the shares to fall 19%, with alleged fraudulent accounting actions being really their primary reason, as well as some various relationship issues between them and related companies, amongst other things, about a 40-page report. But that really can be summed up with alleged fraudulent accounting actions. So moving forward to September 26th, the Wall Street Journal reported that the U.S. Department of Justice was probing SMCI, causing shares to fall another 12%. People really taking that as validity to the Hindenburg report. Then on October 30, brings us to the massive share price collapse of 47% over the past few trading days, as SMC's auditor, Ernst & Young, EY, resigned, which I'll get a bit deeper into that in a minute. So looking at the released unaudited results for Q4 with revenue of $5.3 billion, up 143% year over year. So great growth. That's what people were expecting. That's why the stock was trading at such a higher value earlier in the year. This growth was expected. But now gross margins are significantly lower at 11.3%. The expectation is still for revenue growth, but top line growth doesn't mean much if you can't convert it to profit. That's true for every company, and declining margins really just restrict that possibility. The company does state it expects margin compression only to be in the near term and really to be in that normalized range by the end of fiscal 2025, so halfway through calendar 2025, once its block solutions ship en masse. But now, just coming out today, it is actually being reported initially by DigiTimes that NVIDIA is now rerouting orders that were previously with SMCI to other server providers, which could really throw a wrench in that growth down. So if they can't get that scale, they can't get that margin, they're not getting either that top line revenue as well, if that is true, and that does come and actually materially impact the company. The company earned 55 cents on a diluted per share basis, accounting for that 10-for-1 split. You'll see up there it's $5.51, but it's 55 cents after that split. So one of the core reasons before even any of the fraud allegations or audit resigns, which is something I highlighted earlier in this year when I covered the stock, was just they had an absurdly high valuation for what they do. And it was just extremely, extremely expensive. Just looking at the price to sales, you can see the company shifted from a price to earnings really below one prior to the AI boom. You do expect to go upwards. It's a new opportunity for the company. It makes sense for it to go upwards. But it went up to 7 times sales. And now we are back at a one-time range. In my opinion, the stock was just extremely overvalued in the prior to this last 9 months of dropping, effectively 8 months of dropping. So even when valuing the company using the current stated results, assuming that's all true, the management is in good faith, their sales are correct for the trailing as well as their forward looking at fiscal 2025, is still trading at a trailing sales of 0.9 times, trailing PE of 13.3, which is more in line with historic results. But if you were expecting growth, you would expect something a bit higher than that. But it's closer to historic results than the absurd valuations you were seeing only a few months ago. So if you can believe management, which I personally don't believe, and I'll get into the auditor opinion in a second, the stock is now trading at roughly 0.5 fiscal 2025 sales, which is cheap even by historic standards, even before the AI boom. So right now, the bull case is effectively, do you believe management projections? Do you believe their past data? Because if you were to, they are likely trading at a discount if everything could be believed and taken as fact. But the reason why I and many others at this point put doubt on the management is the company has not filed its 10K audited annual report ending June 30th, 2024. The company has since had its auditors, EY, resign after significant concerns over internal control, board independence, and transparency. SMCI quoted EY's resignation letter stating, "We are resigning due to information that has recently come to our attention, which has led us to no longer be able to rely on management's and the audit committee's representations and to be unwilling to be associated with the financial statements prepared by management. And after concluding, we can no longer provide the audit services in accordance with applicable law or professional obligations." Effectively, they are wiping their hands clean of SMCI. They were only contracted for fiscal 2024. Previously, there was a different auditor, so this was their first fiscal year as an auditor. So it's not like they were going back 5 years; they were going back 1 year on their own work. So, and as a part being listed on the NASDAQ, the company has to file timely, which for SMCI was at the end of September. They got an extension, but if they don't file by November 20th, they can actually be delisted at that point unless they provide a credible plan to file. If they do provide a plan and it is accepted, it pushes out a delistment date to February 2025, which that is pretty much the hard stop date. They'd get delisted at that point if they're unable to produce earnings. The impact of delisting can directly impact the ability of institutions because they have rules behind their investment policies that they have to own stocks traded on exchanges. As well, it can further breach their debt covenants, which have been pushed out to the end of calendar 2024 at this time. But they would be in breach if they were of their debt covenants if they were to wait till February 2025. Management does not expect to need to restate its fiscal 2024 results, but the fact the auditor resigns should not be understated, as it does pose a risk to delisting as well as restatements, which could just further eviscerate the stock price if either or both occur, especially if there is restatements that can just obliterate a stock. It can send it to zero or near bankruptcy very quick, depending on the degree, and you don't really know that until it comes out. So a lot of risk embedded in that. So overall, I just wouldn't touch the stock. Under a long-term fundamental investment philosophy, if you can't rely on the financial statements or the management, which I believe so to be true in this case, it's effectively radioactive. You don't want to get near it. It's just such a high risk, and it's something that you can't really predict because it's behind closed doors effectively. But even then, the company is now facing increased competition from the likes of Dell, HP, amongst other players. A big reason for their growth really was they moved into AI-focused server solutions quick with their liquid cooling. But now other players are starting to catch up in design. They had that first mover advantage, and then that's now looking to disappear a bit. SMCI was nimble, but the first mover advantage can really only take you so far. So I'm even having a hard time buying into that growth story. Even if the financials are correct, there's still risk. You still could have margin compression because they've always had historically higher gross margins than their competitors. But if they're scaling up, they might have to reduce. They have to sell en masse, lower margins at times. So even then, the valuation is not like it's a extreme discount or anything. There's even risk, even if the financials are completely correct, completely true, and reliable. The risks are just overall too high. But I will mention they are reporting the night of or the morning of after we post this podcast. So we'll see if any material changes happens with that.
Yeah, on top of a valuation risk that certainly was there 2-3 months ago, you have you have this risk of accounting issues, risk of and I'm putting it nicely there. It could be fraud, it could not be at this point, but there has been tremendous growth with the business. What Brett talked about, more competition coming in because it isn't a super high end business. It's easy to protect those margins. So, it was funny when I did do that panel, the analyst was sitting next to me, and the stock was this was September 12th. I just looked it up, $44, saying it was super cheap at that time. But again, when we look back at it at that price, it was not super cheap based on historical multiples. And Brett talked about that. Any analyst worth their salt would see that they were trading insanely high multiples based on what the business does and historically. So the drop that he saw that made them, in his opinion, super cheap was from unrealistic levels. It is still needed to drop further and significantly to come more in line with historical multiples. So you've got to be careful who you're taking your advice from. Even if they do look like a pro analyst, make sure that they're doing the right calculations on the business, because again, in our opinion at that time, that was not a company that looked super cheap historically, because it was trading potentially slightly below the average PE. Well, it had for like 10 years, 20 years, so, and it should trade below because of the type of business that it was operating in. All right, we can move on. Brennan, I do know you're going to be looking at Toromont Industries TIH on the TSX. Interesting long-term dividend aristocrat, is like 20 or 35 straight years of
and they've actually paid a dividend. That's 35 consecutive years that they've grown the dividend. They've paid a dividend, I think, going back to like 1968. So, every single year they've
when Aaron Dunn was born.
Yeah.
Well,
close to my
after
dad, I think
he was born.
Yeah.
When he's not here, he's taking strays. He's catching strays.
He's just catching them
He's like, I can't even talk. Sorry.
Yeah. Poor Dunn.
So, yeah, it's true.
But yeah, I'll take it away here. I'll share my screen. This is kind of like a client question, which came from last week's Q&A or chat session with clients, as there was a client who asked about Toromont Industries. We're familiar with the company, and they also brought up another company, which I will highlight a little bit in here, Finning International, just to compare it a touch. So Toromont Industries Ltd, TIH on the TSX, currently trading at about $122.80, about a $10.1 billion market cap, and a dividend yield of 1.56%. So they provide specialized capital equipment in Canada, the United States, and internationally, and it operates in two segments. The first is its equipment group, and the second is its CIMCO or SIMCO, which I'm going to call it. And the equipment group segment engages in the sale, rental, and service of mobile equipment for Caterpillar and other manufacturers. And the SIMCO segment is involved in the design, engineering, fabrication, installation, and after sales support of refrigeration systems in industrial and recreational markets. And at the last quarter, over 90% of revenue came from the equipment group segment. So that is primarily where most of the business is. Now, the stock has performed quite well, long term, driven by its strong financial results, with the stock up about 122% since March of 2018. And over this time, the company has increased its annual dividend payment from about 92 cents per share in 2018 to about $1.92 in 2024. And like I was saying previously, impressively, the company is really a dividend aristocrat, having grown its dividend consistently for the past 35 years. Now, let's look at the financial results which have been driving the share price and dividend increases. So first, looking longer term here, we can see that revenue has had a positive trajectory since 2014 and has grown over the last 9 years with a compound annual growth rate of 12%. And most impressively, net income has grown with a compound annual growth rate of about 16.7% over the same period. Now, looking more granularly at the most recent quarter for Q2 of 2024, ended June 30th of 2024, revenue was up about 16% to $1.36 billion and was driven by strength in both operating segments. Net income was $135 million or $1.65 per share, which is actually down about 3% from a gain of $139 million or $1.69 per share in Q2 of 2023. And backlog was $1.3 billion as at June 30th of 2024, which was similar to that reported last year, but was up slightly from $1.2 billion as at December 31st of 2023. Now, keep in mind, the day that we are recording this is November 4th. And after market today, the company will be actually releasing its Q3 2024 results. So once you're actually watching this video on YouTube, newer results will have already been published. So keep that in mind. And I also wanted to just highlight that there is seasonality in the business, which is something to keep an eye on. And just understand if you're looking to invest in this business, as in the equipment segment, they post their weakest quarter in Q1 due to winter shutdowns, while Q4 tends to be the strongest quarter as it coincides with the timing of customer capital investment decisions. And looking at the trailing valuation, the stock trades at about 19.7 times trailing earnings, which if we compare to its comparable, like I was saying, Finning International, which trades at about 11.8 times earnings, it is more expensive. But if we look at the balance sheet, we can quickly pop up or pick up on at least one reason why it is demanding a higher valuation multiple in the market. And just a quick side note as well, if we look over the past 5 years, the median price to earnings, trailing price to earnings multiple for Toromont is about 21 times earnings. So, it's just slightly below its median right here. But looking at that balance sheet here, so this is both Toromont on the left and Finning's balance sheet on the right. First, we can see that Toromont has a net cash position of about $126 million. Meanwhile, Finning's balance sheet is in a net debt position of about $2.6 billion and has a net debt to EBITDA multiple of about 2.3 times. So again, seeing the much superior balance sheet of Toromont, the elevated valuation multiple begins to make a bit more sense. And it'll even make a little bit more sense if we look at the growth as well, as Toromont has grown a lot faster. Now, just a couple of operational updates here. On September 19th, the company announced its normal course issuer bid to buy up to 8.2 million common shares. So it's going to continue to buy back shares, which is good to see. And on September 9th, the company announced the acquisition of Tri-City Equipment Rentals, which gives the company more of a footprint in southwestern Ontario. But there was limited information on the purchase price, with the company only indicating the purchase price for the transaction was paid in cash using available funds and is subject to customary post-closing adjustments, and it's not expected to have an overall material impact on Toromont's combined revenue, earnings, or balance sheet. So that's all the information that they really provided. So to conclude here, Toromont is a solid dividend aristocrat, having grown its dividend for 35 years consecutively, and only pays about a payout ratio of about 29%. Now, the company has a solid cash-rich balance sheet and robust backlog. And compared to peers like Finning International, investors must pay up, at 20 times earnings for Toromont. But seeing the better balance sheet and history of growth, I certainly see why the stock trades at a premium. And if someone was looking to hold Toromont in their portfolio long term, I would have a hard time arguing against it. I do think that long term, this is a business that does offer value. The stock may be closer to fair value near term, just because, again, it is trading at a premium to the market. But again, for a long-term holding, I think that it's a quality business.
Yeah, and it may be one of those companies, or it is one of the companies that we have on our radar screen right now. And if there is a market pullback, a market correction, it might be a name that we would look at holding or adding, for the long term.
Exactly.
Yeah, and there's a number of those right now that we see having good value, but are we wanting to buy them at current price? Maybe not, but we may find a time when we would like to buy them. And there's companies sometimes we want to monitor 5 to 10 years before we find a good entry point in these businesses. But we're certainly looking at that business. It's a solid business, and it's grown both its dividend, revenues, cash flow over the long term. That's what you like to see, and it's not a surprise that it's have a good share price appreciation over the long term. Okay, did we have anything else further we wanted to get to? Get your tickets for our upcoming live webinar, last of the year. We'd love to see you there. Answer any and all your questions there. You're going to get 6 to 7 stocks you can buy. So, and a look at how we build our portfolio. Plus, we're doing a market outlook at the start, just looking at where we think the markets are today, areas to avoid, and areas where you can still profit, regardless of what the markets do going forward. Okay. I think that's going to end our show for this week. Hopefully Aaron has a voice next week and he would be back. Again, keep your questions coming into our Your Stock, Our Take segment. We will review those and answer those questions on a weekly basis. If you're watching this right now on YouTube, smash that subscribe button. If you're listening to this wherever you consume your podcasts, rate and review us. And as always, I'd like to wish you profitable investing. Thank you.
Thanks, everyone.
Thank you.